This empire didn't fail because it was attacked. It failed because its greatest strength stopped listening. Trade was supposed to respond. Prices were supposed to signal. Losses were supposed to force change. None of that happened. Money kept moving in circles while power moved elsewhere. Profits existed, but they no longer meant control. Success continued, long after it stopped working. The system didn't collapse under pressure. It ignored pressure, and that was the mistake, because an economy built entirely on movement has only one weakness. The moment movement stops creating advantage, wealth turns into dead weight, and decline begins quietly. Power here never came from size. There wasn't a massive population to draw soldiers from, no endless land attacks, no imperial heartland that could absorb mistakes. Everything depended on speed instead of strength. Ships mattered more than territory. Credit mattered more than conquest. Influence traveled along routes, not borders. While other states invested in holding land, this one invested in keeping things moving. At the center sat a city designed for circulation. Capital changed hands faster than armies could march. Merchants carried more authority than nobles. Decisions were made in counting houses, not war rooms. There was no attempt to dominate the world through force. Instead, the system positioned itself between everyone else. Goods passed through, information passed through, money passed through, and every pass created profit. This wasn't an empire that ruled places. It connected them. Because capital could move freely, risk could be spread. Losses on one route were balanced by gains on another. No single failure was fatal as long as the network stayed active. The entire structure assumed one thing above all else, that movement itself would always create advantage, that faster circulation would always outperform slower power. As long as goods flowed, the system corrected itself. When one route weakened, another compensated. When margins fell, volume expanded. The machine didn't need force to survive. It needed uninterrupted motion to keep translating speed into dominance. The system wasn't built on owning resources. It was built on moving them. Goods were bought where they were abundant, transported across distance, and sold where scarcity pushed prices higher. The profit wasn't in production. It was in connection. Margins were thin by design. No single voyage needed to be spectacular. What mattered was scale. Hundreds of routes, thousands of transactions. Risk diluted across oceans instead of concentrated in one place. Speed made the difference. Faster ships meant faster turnover. Faster turnover meant capital could be reused again and again. The same money generated value multiple times before anyone else could react. This only worked because trade was treated like a machine. Inputs went in, outputs came out. Losses were expected and absorbed. Gains multiplied through repetition. Private capital funded voyages, but it didn't operate alone. Trade and finance fused together. Risk was pooled. Returns were shared. Losses didn't destroy individuals. They were spread across investors. As long as goods kept circulating, money expanded without needing territory or tribute. Wealth wasn't stored. It was kept in motion. The system corrected itself automatically. If a route became crowded, profits fell and capital shifted elsewhere. If demand surged, supply followed. No central command was needed because price signals did the work. But machines only work when conditions stay within tolerance. When stress increases gradually, systems don't snap immediately. They adapt at first, then compensate, and eventually start absorbing damage without showing it. Success didn't break the system overnight. It crowded it. As profits accumulated, more money entered the same routes. Investors chased the returns they had already seen. Capital flooded into familiar trades because they felt safe, not because they were still optimal. The number of opportunities didn't grow at the same speed as investment. The network expanded, but the best routes filled up first. Margins tightened. What once delivered outsized gains now delivered steady but thinner returns. Nothing looked wrong at first. Money was still being made. Ships still departed. Accounts still balanced. But the logic had shifted. Growth was no longer coming from discovering new advantages. It was coming from repeating old ones with more money. Risk increased quietly. With so much capital concentrated in similar routes, the disruption no longer hit one investor. It hit many at once. Diversification existed on paper, but correlation rose underneath. The system didn't collapse, it normalized. Returns slowed, volatility increased. To maintain income, larger volumes were required. More capital had to move just to earn the same profit. Speed mattered less because everyone was fast now. This wasn't failure. It was saturation. And in saturated systems, small shocks don't cause explosions. They cause friction, delays, inefficiencies that compound slowly, the kind that don't trigger panic, but gradually teach capital to accept less for doing the same work. Crowding alone didn't end the system. Pressure did. And this time, it didn't come from inside the market. It came from outside it. Other states began treating trade as leverage instead of exchange. Routes that once operated on price and speed were now shaped by policy. Access depended less on efficiency and more on permission. Costs rose without corresponding increases in volume. Delays appeared where none had existed. Certain paths narrowed, others closed entirely. Not because demand vanished, but because neutrality did. Trade had always worked best when it stayed invisible to power. Once it became strategic, it stopped being flexible. The same network that thrived on openness now had to navigate interference at every turn. The system tried to compensate. Capital shifted. Routes were adjusted. But each adjustment carried friction. Every workaround reduced efficiency. Profit didn't disappear. It thinned. The logic of circulation began to break. Movement no longer guaranteed advantage. Faster execution couldn't outrun restrictions. Volume couldn't offset rising costs. Trade wasn't being defeated. It was being slowed down. And because the system depended on momentum, even minor resistance had outsized effects. When speed is the source of power, anything that forces waiting quietly erodes the entire structure, even while activity continues on the surface. And by this point, trade wasn't just a network anymore. It was an institution. Routes were formalized, decisions slowed. What began as a flexible web of merchants hardened into a system that assumed the world would keep behaving the same way. A single chartered company came to sit at the center of this machine. Private money, public backing, exclusive routes. On paper, it reduced risk. In practice, it concentrated it. Decisions that once happened on docks and in counting houses now waited on reports, approvals, and distant boards. Distance mattered. Ships took months to return. Information arrived late. By the time losses were visible, capital was already committed to the next cycle. Adjustments lagged reality. Overhead grew. Administration expanded. Layers formed between capital and cargo. The organization designed to manage uncertainty became slow at responding to it. When conditions shifted, the system didn't pivot. It absorbed the strain. Corruption didn't explode. It diffused. Small inefficiencies multiplied across long supply chains. Delays were normalized. Underperformance was tolerated because the machine was still running. From the canals and exchanges of Amsterdam, the numbers still looked fine. Dividends arrived. Paper wealth held steady. But flexibility, the original advantage, had thinned. Routes were locked in. Capital preferred familiarity. Risk avoidance replaced experimentation. The network that once thrived on movement now depended on repetition. Trade didn't stop. It standardized. And when a system built for circulation starts behaving like a fixed structure, it doesn't fail loudly. It keeps operating out just with less sensitivity to change, less ability to correct, and more reliance on the past continuing to pay for the present. As trade slowed in its ability to generate new advantage, capital didn't wait. It adapted faster than ships ever could. Money began looking for returns that didn't depend on weather, routes, or distant markets. Returns were still expected, just without movement. Investment drifted away from cargo and toward paper. Government bonds offered reliability. Foreign debt offered steady income. Speculation promised gains without months of waiting. Wealth no longer needed sales to grow. At first, this felt like progress. Capital was safer. Losses were smoother. Income arrived on schedule. The economy didn't look weaker. It looked more sophisticated. But something subtle changed. When money earns money without goods moving, the feedback loop breaks. Trade no longer disciplines capital. Poor routes don't get abandoned quickly. Inefficient systems don't feel immediate pain. Financial returns cushion operational failure. Ships could underperform and it wouldn't matter. Dividends still arrived from elsewhere. Trade could lose relevance and the balance sheets wouldn't show panic. Comfort replaced urgency. The economy didn't stop making money. It stopped needing trade to do it. That separation mattered. Because once finance detaches from real movement, inefficiency can survive indefinitely. Losses no longer force correction. Weak structures stay standing because something else is paying the bill. Wealth became quieter. Less dynamic, more self-contained. Capital circulated within ledgers instead of oceans. And when a system built on motion no longer depends on motion to survive, stagnation doesn't register as danger. It registers as stability, even as the mechanisms that once created power continue to erode underneath. Normally, markets punish inefficiency. Losses force adaptation. Routes close. Capital shifts. Systems evolve because they have no choice. Here, that pressure softened. Wealth acted as insulation. And when returns dipped, they didn't threaten survival. When routes underperformed, they weren't abandoned. The system could afford to be wrong for a long time. That comfort delayed response. Bad structures didn't collapse. They lingered. Capital kept flowing through familiar channels even when they no longer produced advantage. Not because they were efficient, but because they were established. Stability became misleading. There was no shock strong enough to demand reform, no sudden failure to expose decay. Trade inefficiencies accumulated quietly, protected by financial depth. The system didn't feel decline when it started. It felt normal. Movement continued, but its meaning changed. Speed no longer translated into dominance. Volume no longer guaranteed influence. The mechanisms that once forced constant improvement lost their bite. When correction disappears, decay stretches out. Weakness hides inside routine. By the time pressure becomes visible, adaptation costs far more than it once did. Trade hadn't stopped. It had stopped teaching. And without feedback, even the most advanced commercial system can keep functioning long after it stops producing real power, mistaking continuity for resilience and familiarity for strength. From the outside, everything still looked impressive. Accounts were orderly, credit was trusted, ports stayed active. The system didn't seize up, it kept humming at a lower intensity. But influence was no longer being set here. Rules were being written elsewhere. New routes formed that didn't need this network. Innovations appeared that didn't pass through these exchanges. Trade kept happening, just not on terms that mattered as much. Activity masked erosion. Because ships still arrived and money still moved, the loss of edge went unnoticed. What changed was who benefited most from movement. Speed was matched. Information advantages narrowed. Capital no longer arrived first. The economy stayed rich but less decisive, organized but less central. The ports were busy, just not commanding. The exchanges functioned, just not setting the pace. Power didn't vanish. It relocated quietly while routines stayed the same. What had once amplified every movement now merely processed it. The machine still worked, but it no longer shaped outcomes. And when dominance fades without drama, it's easy to believe nothing important has changed, even as relevance slips away, transaction by transaction. That's how decline stretched across decades. Not as collapse, but as a gradual loss of necessity in a world that learned how to move without needing the system at the center. What failed here wasn't discipline, ambition, or intelligence. It was scale without adaptability. A system optimized so perfectly for one kind of world that it struggled when the world changed shape. Trade didn't disappear. Wealth didn't evaporate. Institutions didn't collapse. What vanished was leverage. Movement continued, but it no longer translated into control. Capital still circulated, but it didn't shape outcomes the way it once had. The system kept doing what it was designed to do, just in an environment where those actions mattered less. This wasn't a violent mistake. It was a quiet one. Optimization outpaced flexibility. Stability outlived usefulness. Success lasted long enough to become inertia. Empires built on force fall when force fails. Empires built on trade fall when movement loses meaning. And when circulation stops creating advantage, even the most sophisticated economy can keep functioning right up until the moment it realizes the world has learned how to move without it at the center.